Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Patrick Donahoe. He is the president of Paradigm Life. Welcome to the show. It's nice to be with you.
It's great to be with you, Jordan. Thanks for having me on.
So let's just do a little bit of your background before you became the financial planner that you are. Just kind of a brief history of your history before you got to where you are now.
Wow. Well, I've been doing what I'm doing now for a while, since 2007. But yeah, I discovered what I was doing just a couple years out of college, and so I grew up on the East Coast and played hockey in college for a few years. Then I did a church service for a couple of years. Then I moved to Utah and didn't know anybody, but finished school up here and met through both hockey and school, just a group, and I lined up with them and learned sales and learned some financial ideas, learned online marketing, and this was back 2005, 2006. Then I met a financial advisor who's actually the personal financial advisor for Robert Kiyosaki, and I had read a couple of her books and met up with her, and she became my mentor. And so I learned a different way of approaching personal finance that is atypical, and I've been doing that since, like I said, 2007. But it's mostly been online, right? So most financial advice, financial planners, and services is oddly enough, still done face to face over a conference room table or at your kitchen table. And so I've done business online through video conferencing and so forth, since 2007. And, I got a kind of a wake up call 2008, 2009 when, a lot of the typical strategies that individuals think are going to get them certain results or outcomes came crashing down. And I learned, quite a bit about, just some of the other side of the spectrum when it comes to people's expectations and, the actual opposite of that, which is a lot of failure, a lot of disruption. And, it was humbling to me just seeing what people were going through. And so I wrote the book. I wrote a book recently last year, 2018, and a lot of it just tells the story about a lot of what individuals think is going on with their finances and the outcomes that they're expecting. But how that conflicts with a lot of the numbers that you see when it comes to what people are actually getting as a result in personal financial planning.
So the name of your book is called Heads I Win, Tails You Lose. This is kind of taken from the point of view of Wall Street, basically, that Wall Street is always winning and the individual investor is losing. Is that what you mean by that title?
Well, here's a lot of the heads I win, tails you lose. It's a saying that has multiple meanings, and I didn't realize that until Donald Trump and his campaign, and it's used quite often in a different context. So the original heads I win, tails you lose is basically to set yourself up so that you never lose. And so that is kind of the notion is, okay, what's a financial strategy that you can set up and not lose? And that's essentially what the book is about. But I look at, Wall Street and banking is set up for the benefit of the guys that actually advocate it and propagate it, not necessarily the end user or the end individual.
So you talk about Wall Street promoting debt as far as credit cards and mortgages and lines of credit, promoting 401ks where your money's tied up for a long period of time, promoting mutual funds. What is wrong with the kind of traditional system that Wall Street is promoting?
Well, I think there's two inherent things that are, and maybe it's not wrong. It's like it's set up. This is what they offer, and I don't think inherently that they're bad. I just think that the expectations people have as far as what's going to be done for them is way out of alignment to what the actual results are. And so, so I step back and I look at, okay, what's the origin of the retirement system? Because the word retirement, didn't really exist until to this kind of modern era. And it, really the idea goes back to the same source of our education system, which is Otto von Bismarck, and how Prussia and Germany were set up. And I look at what the idea of retirement is. Not necessarily natural to life. I mean, it didn't really exist until modern financial planning. People just didn't, retire. So the idea in and of itself is, I think, flawed because number one, we're meant to produce, we're meant to work, we're meant to contribute. And I think something dies in us when we're no longer doing that. So that's the first thing. And then the second thing is, you look at just the history of the retirement services industry, right? And you had pensions that were the original kind of retirement plan. But when those failed and bankrupted companies, because of the obligations companies took on for a really long time, that's when what we know today as typical financial services, whether it's mutual funds, 401ks, tax or plans that defer tax until you're 60 years old, right? Those are, no one's really fully retired off of those yet. And, so I look at just what the results are of whether it's returns, net returns after fees and so forth, right? It isn't that pretty. It's not getting the results that people want, and they're falling way short of what the current expectations are. And I don't think people are going to be able to retire and not retire for that long.
So your strategy is what you call a perpetual wealth strategy, which is a different way of doing things than you would normally have.
Correct.
So just and basically you're using a form of cash value life insurance from a mutual insurance company. So let's kind of go into that a little bit. Before we get to the details, just kind of what is the overall goal of the perpetual wealth strategy, and how is it different from traditionally what people get from Wall Street?
Well, the overall goal is to, achieve a level of financial independence as soon as possible, as opposed to the age of 60 years old or 65 years old. And, that equation is a function of, the financial vehicles that you use. But I would say the insurance side of it, I know we're going to go into some details, but that's not the end all be all. It's just the foundation. But I look at, really how our society has evolved. And I don't think individuals, number one, naturally can stop contributing and have a successful, fulfilling lifestyle. And so I look at really the modern era and the jobs that exist that you can do 10, 15, 20 hours a week from anywhere on planet Earth, right? As long as you have an internet connection. They're available, and most people don't realize, these are opportunities. And I think if you really look at, positioning yourself and what your career is, and getting training and certification, investing in yourself, making yourself more valuable, then you align with whatever those positions, employment positions are, whether it's consulting or whether it's freelance work. But there's a lot of companies now that have a lot of virtual employees. WordPress is one of them that has thousands of them. So the idea is that, you essentially create a financial foundation where it's reserves, cash, liquidity that has decent growth. You have a savings plan to an extent. But then the primary investment is yourself, and investing in things that you can do to improve how much money you make, and then figure out ways in which you can create a lifestyle that is a combination of your assets, the cash flow that comes from your assets, as well as a meaningful career. That's kind of how we define working 10, 15, 20 hours a week in something that you love to do, but it's on more of your own terms instead of an employer's.
So the key account that you use as part of the perpetual wealth strategy is what you call the wealth maximizer account. Just describe briefly what that account is and what are the tools used inside that WMA.
Yeah, so the wealth maximization account is basically just a way you can set up life insurance, and it's set up for more of a growth as opposed to protection. And so it's setting it up that way and getting very prudent returns with tax benefits as well as liquidity that has over 100 years of not losing any money. And so it's one of those things where it sits as the foundation. We call it your tier one capital. And funny enough, this is where a lot of banks and corporations, they actually set up these types of insurance policies on employees, and they keep and use those as their tier one capital, like their most valued reserves, and it's measured more than anything else when it comes to bank stress tests. So you look at that as sitting at your foundation, and it's because of its performance, its liquidity, its protection, its safety. But then you also look at a financing side that it has. So insurance companies, they with certain policies and certain types of companies will actually give a line of credit against the actual value of the policy itself. that has very favorable terms, low interest rates that you can use, whether it's making investments in yourself. And there's a lot of other opportunities there that I talk about in the book. But that's the idea of having that as your foundation, and that's pretty much where we start. But then from there, it really has to do with the person in question and what level of financial education they have, what they're doing for their career. But yeah, that's where I see financial freedom as possible, is with the equation of having that as your foundation, plus you have a strategy to invest in yourself, make yourself more valuable, and then make more money. But then also, align yourself with a position, a job, a career that that is associated with your strengths, your abilities, stuff that you like to do, that you can do for the rest of your life.
Yeah. So let's talk about the insurance component of this, because the traditional view of particularly whole life insurance is that it has very low returns, it has high fees, big commissions of various types.
Yep.
It grows very slowly over time, and when you borrow against it, it's at high interest rates. So it's not a good way. Most traditional people would say buy term, which is cheap, invest the difference in stocks and mutual funds, and you'll do far better. Describe what's wrong with that kind of traditional view of insurance from your point of view.
Well, I mean, there's multiple points of view, even more on top of that, when it comes to policies that are designed with mutual funds inside of them, as opposed to, what we advocate, which is just overfunded whole life with a mutual company. But yeah, you look at the buy term, invest the difference, and you said traditional, but that actually is a strategy that came about in the 80s. So it's a typical strategy. It's not necessarily the traditional one, because again, if you're a mutual fund company and you look at people giving you money, right, then it has to, go to you instead of somebody else. And so I look at, just the campaign associated with, being able to buy cheap insurance and then, earn 15 to 20% in a mutual fund, which is obviously unrealistic. And you're going to outperform whole life. But I think the assumptions, right, is where the assumptions and the results really is what tells the truth, because that hasn't been the case. And so you look at, whole life, and it's not necessarily to replace an investment. I mean, it's not an investment in and of itself, right? But it sits as the foundation, right? And it's a foundational vehicle that people usually will put bonds into or cash into. It provides better tax benefits and better returns. And then you look at also the expense side of things, which I think is also really interesting to analyze. And I did that in the book. We have a whole spreadsheet that talks about, the typical fees with mutual funds, as well as qualified plan wrappers, and that, the fees that you end up paying over the course of time versus the fees that are charged with an insurance policy. And you have hundreds of % more fees inside of the typical mutual fund and 401k setup than you have in insurance. But again, that's in the book. We have a whole spreadsheet and research there that was done to prove that out. But yeah, I mean, there's a lot of, again, it comes down to he said, she said. But if you think about, a way in which Robert Kiyosaki identifies opportunities, there's not a bad opinion and a good opinion. There's two opinions, right? And he calls it the three-sided coin, right? You have one side, which is heads, one side, which is tails, that represent two different opinions. But the third side, which is the edge, is where you take both sides, you sit on the edge, and you figure out, okay, I don't care who said what, or who's right and who's wrong. I care about what's right and what's right for me. And if people do that, they're going to, I would say, be shocked.
So let's talk about how you can use this in your own life, the WMA account. So insurance, it's not as though you put a huge amount of money in up front and borrow it out right away. You have to pay premiums for several years for it to build up before you can build up cash value to borrow out. Is that the way it works?
And that's a perspective. It can be set up where it does take a really long time to establish cash value and be able to use some of it for whatever the purpose is. But the wealth maximization account, again, it goes to a specific design where it's designed for immediate cash value. And so there are ways in which you can set it up that's compliant with the IRS regulations, where you do have 60, 70, 80, sometimes more % of what you put in the first year that's available to use, and that's available to use immediately.
Is this true for all mutual whole life insurance companies, or are there some that do it better than others that you would use? Well,
it comes down to mutual companies don't all allow for this type of setup of insurance, but the more popular ones, New York Life, Mass Mutual, Northwestern Mutual, they allow for it. Some of them restrict the use of borrowing or using cash value in the first year, but the ones that we typically use and advocate do allow for that.
So what would be the ideal way to do this? You start when you're in your 20s, or you start relatively young. You might not have a big salary at that point, so you may be contributing less, but over time you want to contribute more, and then you borrow it out in retirement as an annuity. Just kind of go through the strategy of how you'd actually implement this.
No, that's a great question. Well, it depends. Yeah, it really depends on the person's situation at the time. Obviously, if it's a younger individual, they're going to be restricted as to how much they can put in, right? Because they're paying off student loan debt, entry level wages. So you could start small there. You can start on little kids. I mean, I have a number of policies on my 3 kids, and you can start really small and have them build up over the course of time. But you also have those that are already established, have already built wealth, have already, accumulated money in a 401k or an IRA or equity inside of real estate. And so the strategy, at that point, is ultimately to still set up a wealth maximization account, but you take into consideration both the ability to borrow, the liquidity side of it, but you also can position it as the legacy asset, where you establish essentially a death benefit or money that will transfer to your beneficiaries. But what that does, it allows you to do a higher withdrawal rate on other assets, right? And so if you look at the research and the analysis that's been done in regards to the distribution rates with securities or portfolio-based assets, right? It's insanely low just because of the amount of volatility out there. So right now, for a 20-year period of time, factoring in inflation, it's a 3.5% withdrawal rate from securities-based assets. But if you look at one of the things you said, Jordan, which is how can you annuitize it? Yeah. What you can do essentially is you can annuitize other assets. And if this is in place, because if you look at what an annuity is versus life insurance, annuity is insurance from living too long. Life insurance is essentially, protection from dying too soon. So basically what you're able to do is annuitize other assets. And right now, for a 65-year-old, rates as far as a pure income annuity is concerned, no deferred annuities or variable annuities or anything like that. This is just like pure income annuities, right? You can get, 6.5%, 7.5%, depending on the situation, which is obviously much higher than the 3.5% distribution. Now, the trade-off is that, if you annuitize an asset and pass away, the stream of income goes away. However, if the wealth maximization account is set up, the life insurance is set up, that will pay out. And so it's one of those things where you can kind of straddle both sides of the insurance company, right? Where they're obviously insuring for people living too long and also providing insurance for people that, prematurely pass.
So the idea is that you're going to get a death benefit on the insurance side, whereas with the annuity, if the annuitant dies, you basically have lost the principal.
Correct.
So that's the big difference between the two. Okay, so let's talk about...
the insurance pays out when the annuity goes away. That's the idea, is that you have it set up, and usually the ratio is 1-to-1, right? So if you are annuitizing $200,000 of assets, you want $200,000 of life insurance in place, right? The wealth maximization in place.
The two of them work together, is what you're saying.
Correct, absolutely, yeah. So if one goes away, if the annuitant passes away, then life insurance pays out, right?
Yeah. So talk about the process that you go through at Paradigm Life. So somebody comes to you with some mutual funds, some stocks, 401ks, maybe some term insurance. How do you go through taking what they have and converting it into the perpetual wealth strategy that you talk about?
Oh, that's a great question. So, usually what we have, the software that we've developed, and we use another software of that mentor that I had mentioned. Her name's Kim Butler. She and her company have developed software around everything that we do. So what we'll typically do is take a person's situation and then we'll model out, what their future looks like over the next 10, 20, 15, 30 years. and actually show what the results will be of what they're currently doing. And then what we'll do is we'll show another path, and that path is essentially incorporating some of the principles that we've talked about here. It could be setting up one policy, multiple policies. It could be factoring in the potential to annuitize. It could be there's not enough money, that the assumptions are, well, you're saving 10% of your income, but you really need to be saving 30 to 35, right? So in the end, the idea is essentially to put a person on a better path than what the typical financial plan offers. And so that's where we'll really determine where savings is going, whether it's a 401k or an IRA or somewhere else, and we'll maybe redirect some of that to insurance. But if people already have established assets, right, that's when they can continue to do maybe some of what they're already doing, but then prepare for potentially annuitizing those assets. But you're going to have to pair off of some of the contributions in order to set up the insurance policy. But either way, I mean, the end result of working with clients is that we give them a path and show them where they'll be without changing anything, right? But then we'll also give them a path and show them, okay, here are some adjustments that you can make, and this is the results that you'll wind up with. But in the end, I've done a million of these, and that's where I'll tell you, like what I said in the beginning, it's like people don't know, they don't realize how much money is required, to really, truly retire for a good 20, 25 year period of time. I think people are, if they understood the math, then they'd realize that it's going to take, 30, 40% of their savings to actually just, to retire off of what their current income is.
So how would the plan you just described be different from what people would get if they go to a traditional life insurance agent? It's a great question. I mean, I think most life insurance these days, it's kind of, there's two camps, right? You have one camp that's the insurance agent / typical financial planner, but then you also have just pure life insurance person. So, and I think we fall kind of in the middle. We refer to ourselves as financial advisors. We, carry Series 65 and are able to provide investment advice. We don't have any assets under management. But the idea is to really look at, okay, what piece does insurance play? Because I think a lot of insurance guys, think it's the end all be all. And I don't believe that. I think that, it is the foundation, but then there are a lot of other things based on who the individual is that sit on top of that. And so that's where, again, I know that there's a lot of other financial advisors out there that are pretty amazing and do good and get good results. I would say the typical financial planner, is just a salesperson to an extent, taught to sell balanced portfolios and this percentage of equities, this percentage of bonds, and then put all your money there and then buy cheap term insurance and hope you have more money at the end, but which is typically not the case. But the idea is that you have to do your due diligence, even with us. And that's what separates us, I think, is because we're online, because we do all of our business over the internet, we've had to put a tremendous amount of resource and focus into online education. So you can learn about 100% of what we do for nothing. You can go onto our website and register for our e-learning, and you can essentially learn without having to ever talk to somebody and feel like you're getting sold. I mean, we're big on financial education. We want this to be the right decision, and that's why we put so much effort into actually, creating a space where somebody can learn on their own to see if it is viable for their situation. So, just tell us a little bit more about the resources available at your website, which is paradigmlife.net.
Yeah, so we've this is our, I think, fourth version of like a e-learning platform. And so it basically houses video tutorials. There's some, quizzes and check your understanding things in there. There's some worksheets and spreadsheets. And we also have, a number of articles that apply to different situations. I mean, I wrote an article, before the book that was, how to get a 10% raise every year for the rest of your life, which is, essentially what we were talking about, where it's investing in yourself and figuring out how to make more money. And, over a 30-year period of time for $100,000 of income, there's a difference of about $11 million in total earnings between that and the person that typically, gets the 3% annual raise. So there's that in there that gives ideas of, okay, what can you do to, learn more about yourself, which is, taking personality tests like Myers-Briggs or Strengths Finders or Colby, and then figuring out, what are the positions that are out there that align with my strengths, and then how do you maximize those, get your training, your certifications, so there's articles like that. We also work with a lot of real estate investors who already are thinking outside the box when it comes to their finances, their personal finances, and so we work with them as far as incorporating this into an overall real estate investment game plan. So we have a course that goes through that. We have a course for families. We have a course for those that are maybe approaching retirement age and what are the options for them. So anyway, yeah. So there's a lot of stuff on there, and it's pretty easy to navigate. So you just have to create a username and a login, and you're there.
So let's talk about some of the ways that you can use the money when you're borrowing money out of your wealth maximization account. There are different ways to use it that you think make sense. One of them is real estate. How should you borrow out and make it worthwhile investing in real estate?
Yeah, and I just want to clarify one thing. So if you look at, and this is again, it's a different strategy. That's why it may seem somewhat confusing. But the insurance company actually lends their money against it, right? Insurance, your cash, the money that's yours, that's growing, right, is doesn't get touched, right? And so that's where the insurance company gives a loan from their other accounts, their other assets, against your plan. So you have that money growing, plus you have use through a policy loan, which right now interest rates are anywhere from 4 to 6%. And you can use that, like I said, for a variety of things. So I'll address the real estate first, then I'll go to the personal development second. So the real estate one is, where individuals that are investing in real estate, let's just use a simple, single family rental, which has become really popular over the last 10 years, just because of people that were lost their homes and just decided to rent and decided to keep on renting. And so the rental market is huge. So typically with purchasing a rental property, you have to put a down payment, and then a bank will lend you the rest. And so what the policy loan would do is the insurance company would lend you money against your policy as the down payment, and then you would make that down payment, send the money to the title company. And then with the cash flow that comes from that real estate, you would set up a loan payback to both the first mortgage company, but also the second mortgage company, which is ultimately the insurance company at this standpoint. The only difference, though, is that most banks, most mortgage companies will put, a lien on title, and if you don't pay, they will take the property. With the insurance company, they don't require collateral for their loans, and the collateral is the insurance policy, and so as far as loan paybacks are concerned, it actually is very flexible. They require interest only every year at the end of the year, end of your policy year, and then you also have the opportunity to defer that until the subsequent year without penalty. So very flexible loan provisions.
So but then, if you want to do positive cash flow real estate, the rentals are enough to cover the underlying mortgage and to cover the payments on the insurance policy loan. Yep. Is that what you're saying?
Absolutely. Yeah. I wouldn't recommend buying properties that don't cash flow. So yes, that's the idea is,
and then over time, the idea is that the value of the real estate will grow, as will the income. So that's why it's a good way to build a portfolio in addition to your insurance.
Correct.
Is that what you're saying?
Yep.
Okay. So that's the first. The second one, as you say, is personal development. So
I think it goes hand in hand with the real estate, right? Because most people have been I include myself in this. Most people have been conditioned just to listen to somebody else to tell them what to do with their money, and I don't think that's not wise at all. There has to be some stewardship taken by the individual. So whether it's learning about purchasing investment real estate, right, which could be going to a conference or hiring a coach or there's a number of ways to do that, but making an investment there, I think, takes precedent over actually getting into real estate and learning on the fly. So, but then it goes to the personal development side of things too, where learning about marketing or getting a certification if you're a software developer, or learning management or leadership skills. There's so many different courses that are available, and they cost money, right? Whether it's travel or the fee that you actually pay. But you look at that investment, it's the investment where you have the most control and the most certainty associated with the outcome. Now, the due diligence in advance is that you want to make sure that there's a return there. So the idea behind getting leadership training, the idea behind learning how to do marketing or get a certification in design or web development or whatever, you want to make sure that it actually positions you to get a higher salary and more pay than you're currently getting, right? So that research takes precedent, but then it's making those investments and then subsequently getting your return from an increase in salary.
Yeah. Another way you say is you should borrow against the insurance or against the wealth maximization account to pay for college for your kids, or at least build up money for college tuition so that you don't have to borrow. How does that work?
Well, this is, I'll say this about, I don't think college is as good of an investment as it once was. I think you have to be very, very, very similar to the due diligence you do on personal development or investing in any type of asset, or it's doing due diligence on college too, right? Where typically parents are putting, hundreds of thousands of dollars on the line. Their kids are taking on hundreds of thousands of dollars of student loans, but what's the outcome? What's the output? Right. And I think, the narrative has become, all right, I'm going to go to school and I'm going to figure it out there. But then, 4 years becomes 5 years, becomes 6 years, becomes grad school. So that's the idea, is I think a lot more due diligence has to be done in advance of going to college, right? To understand what the outcome is, what the return is, because it's a significant burden on families. It's a significant burden on kids. And because, loans can be deferred and they don't have to worry about it until in the future, that is where once they get there, and it's time to pay the piper, that's when the anxiety sets in. And a lot of people are dealing with that right now with the increase in, student loan defaults. So I won't get into any of those details, but I think the idea, as far as your wealth maximization account when it comes to college, I would say education, and take the same stance as you would take personal development, right? Some education, some jobs don't require education. I've hired, hundreds of people over the years, right? And I don't look at where they went to college or the degree that they got, because I've started to see that, the positions that people are good at do not align with the actual degree that they got in college. Yeah. So I think it's, I don't know, it's a really cool conversation, but I think the evolution, right, of education is definitely worth looking into and being very cautious as far as where you put your money and how you're going to get paid off, because that's the ultimate thing. It's like you're not investing for kids to go discover and find themselves, right? You're investing for kids to really just have a career or a job or a profession that aligns with who they are and what their strengths are. And so, I look at education these days, and I just have some major issues with how it's being orchestrated, and hence the reason why I think there's just some major issues with both the employment space as well as the higher education space. But I'll leave it leave it at that. But yeah, the policy you can use for whatever. So whether it's college education, whether it's personal development, whether it's investment, you can just use it for your family too, instead of using credit cards or automobile loans.
Another thing you talk about is building your business separate from personal development. But you could either start a business or do a franchise or expand your existing business. Why does it make sense to borrow against your life insurance policy to grow your business?
Well, I think it creates a layer of accountability. I look at just the business experience I've had, but I've also had the privilege of working with lots of business owners, right? And learn that the ideas behind business really aren't what make the business thrive in the end. It's really the operation of the business and the understanding of the business owner. And so the idea of, capitalizing a company, most business owners will capitalize it with savings, with cash, but it becomes equity, right? You can use loans and capitalize it with a loan. And when you do that, then you have a loan on the books as opposed to equity, which is, in a sense, kind of it's abstract if you think about it. But a loan isn't. A loan is very cut and dry. You can book on the books of the business on the balance sheet. You can book a loan, and when profits are made, loans are paid back, as opposed to this ambiguity around how is equity paid back. So I look at just business owners in general and the accountability associated with its success. I say would ultimately leads to business failure more than anything else.
Why is whole life insurance the best way to go as opposed to other kinds of cash value policies, variable insurance where you can go up and down with the stock market, universal life, index universal life? There are other kinds of cash value policies. Why is whole life preferable to those?
There are, yeah, and I've seen a number of them, right? And I think it comes to the scale of control, certainty, and risk. And I look at other policies I think have been set up to be a competitor to mutual funds, to investment-based assets. Whole life is not that. I mean, it's been around the longest. It has a degree of certainty that's unmatched. And although other policies may beat it, I would question whether it's worth the risk. And so that's where it's a foundational asset. It's an asset that has a degree of certainty that doesn't exist with other assets, right? And you can bet on it. Whereas these other types of policies that are out there are so many different moving parts and fees and ways that they can be adjusted by the insurance company themselves. And I'm not comfortable with that risk. And based on how we position insurance as a foundational asset, we don't advocate that to clients either.
Specifically, a hot area today is index universal life, IULs. At least what they say is you benefit from the upside. You're indexed to the S&P 500.
Yeah.
If the stock market falls, there's no downside. You just get zero in a year like that. But you're going to earn, typically 12% or much, much higher than you're ever going to get on a traditional whole life. What is your argument against IULs?
Well, I mean, I think they play a role. Again, it comes down to what has the outcome been, and we've seen enough, policy illustrations and statements to show that they have not been as successful as the claims have made, and that's where it comes down to the language of the contract, right? Insurance is it's a unilateral contract, so you have to look at the language of the contract and does that contract give a sense of certainty? And you read through them. And with all the different things they can change and modify according to the well-being of the insurance company and not necessarily the person buying the policy, it just doesn't make me comfortable with it, because not only does the language, it conflicts with the notion of certainty, but I also just look at the actual performance and the results that I've seen with just policy illustrations that we've come across over the years, which amounts to hundreds of them, and it's very misleading. It's unfortunate. But I don't advocate those just because, I can make a better return on myself or a better return with investments. Okay. And the degree of certainty that it has, to me is nilch. So that's where I rely on whole life because of what it's done over the past 100+ years, without losses, always paying dividends. And, and with the rate of return that I may get there, which, it's interesting. At 12%, 14%, we can get into those. We don't have a ton of time, but it's like, yeah, you can get a much better return somewhere else that you have way more control over, as opposed to betting on the insurance company being able to buy options and come up with hundreds of % rate of return on their option investments. Anyway, that's my 2 cents.
So you have throughout your book, which again is called Heads I Win, Tails You Lose, various examples of clients you've kind of turned their life around. Just give us an example or two of the difference this has made in using this perpetual wealth strategy and turning people around from when they came into you in the first place.
Yeah. Well, there's one that just comes out is a couple that's in Seattle, and they're in the tech world, and they were working for some big companies, Microsoft, T-Mobile, and the spouse, she was at a director level with T-Mobile, and then the husband was at Microsoft. He was at a director level too, right? And then when they started to discover these principles, they realized that the idea of freedom and financial freedom, what wasn't there, because they were tied to a job even though they were making a ton of money. And so setting this up, they also learned about investment. They started to do some consulting work. And then the client, one of them bought a gaming company, like role-playing games. One of the most, it has so much intellectual property in it. It's incredible, and it's done millions of dollars in business, right? But it kind of like opened their mind to the possibilities outside of what they were taught, which is go to school, you get a degree, you go to a good strong company that's going to give you benefits and pay you a lot of money. And that's not freedom, right? And they discovered that, but they also realized that the skills that they were developing were valuable outside of those two big companies, but on their terms, which would provide more freedom for them. And they've crushed it. I mean, the husband, they did this by design. But when he left, he still kept a bunch of contacts at Microsoft in the industry, and he was offered. He just got a director position in Europe, over all of Europe, with Financial Force, which is one of the biggest ERPs that's out there from enterprise accounting systems. Anyway, so it's one of those things where it's like, they come in, you set up their foundation, but it's more than that, right? When they realize some of the principles associated with how you can set up your assets, your investments, and then what freedom it gives you to actually go out and pursue things that are they're fulfilling and meaningful. It provides a permission slip to do that. And I think, 401ks and deferred vehicles, it's kind of like it has one purpose and one purpose only, and there's no deviation from that. And I just think that's not conducive necessarily to the rapidly evolving society we live in. But also, again, the notion of retirement, I don't think we're meant as human beings just to kind of hang it up and say, okay, I'm done with life. I'm done contributing and providing to people. I think that kills people.
So the subhead of your book is a financial strategy to reignite the American dream. And that's what you mean is financial freedom and giving people the opportunity to do what they want and still be financially secure. Is that right? Yeah,
that's the origin of the American dream. Right? American dream was to be free, right? It wasn't to own a house, right, or retire. That wasn't the American dream. The American dream, aligns with what all people are driven to do, which is be free. And I think that's the drive behind retirement is freedom. Okay, but I look at not necessarily the best way to accomplish it and achieve it.
Very good. So if somebody goes to their financial planner, their existing planner, and tells them about this perpetual wealth strategy, they're probably going to say this is crazy, they shouldn't do it. What is should their response be to their traditional financial planner using the traditional tools?
Well, I mean, if they didn't say that, if they said, wow, that's the best thing I've ever heard of, I would be really surprised because that's never, ever happened. But that again goes to the three sides of the coin, right? It's like everybody has an opinion and a bias, period. Even though somebody may say that they're not biased, like everybody has a bias. Everyone has opinion. That's how we're wired. So you have to look at, okay, that's one opinion. What's the other opinion? And then you sit on the edge, which is that third side, and determine what's best for you. But yeah, it's one of those. Yeah, it's one of those things where if you go ask somebody that it's a conflicting strategy or conflicting perspective, of course they're not going to tell you that it's a good thing.
Indeed, very good. Well, thanks so much. My guest this hour has been Patrick Donahoe. He is the president at Paradigm Life. You can find out more at his website, which is paradigmlife.net. His book is called Heads I Win, Tails You Lose, A Financial Strategy to Reignite the American Dream. I think we've given people some pretty interesting ideas that they probably haven't heard elsewhere. So thanks so much for being a guest on the Money Answer Show, Patrick.
Oh, it's been my pleasure, Jordan. Thanks for having me on.
Thanks again. We'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.